Hello and welcome to the Future Food Finance Podcast. My name is David Stevenson.
And my name is Paul Cuatrecasas.
And we are the founders of said Future Food Finance. We've been away for the last couple of weeks and some holidays. And we thought we'd come back and talk about a couple of issues that have been cropping up on our food radar. I'm going to talk a bit about carbon markets because I think that's a really interesting subject. But first, I also just want to talk just about the kind of deal flow that we're seeing in the FoodTech space, to which the answer is not very much. And I'd be interested to see your views, Paul. I track every week. I kind of track news coverage of the sector. I sort of look at, for instance, deal flow. Yeah, so this is kind of Series A through to Series C, D, and E. And I mean, it's summer, so deal flow always goes down. It does go quiet, but I've definitely noticed that stuff has fallen off a cliff. And that whilst deals are getting done, and interestingly, in the private space, seems like quite a lot of more deals getting done in Asia, which I think is maybe an interesting indicator. But I suspect, unsurprisingly, deal flow has fallen off a cliff. And that's probably because, I don't know what you think, Paul, we are probably only midway through a enormous global sifting out of what's going on out there. What's your take on deal flow at the moment in the private sector?
I agree, David. I think we have seen a significant decline in deals across the board, both capital raisings and M&A deals, just partly this summer, as you say, but also part of the markets. And there has been a greater interest recently, I think, as most of our audience would be aware, in energy, renewables, carbon, which I think is a great topic for today.
Yeah,
and less interest in some of the more traditional staples, especially in an inflation environment and rising interest rates. That will probably continue for some time. So this is an opportunity in terms of, again, speaking as an investor, to watch valuations adjust. And they're most likely going to adjust in the direction that downward, which is an opportunity for investors. We'll have to see how this unfolds over the next 6 or 12 months. But it is probably going to be a pivot, as we're seeing now, starting a pivot into more profitable companies, or companies that can get to profit more quickly if they are today losing money. If it's a longer term fundamental play, such as a lab meat company, then it's not so consequential, because the expectation has always been it'll be 2, 3, 4, 5 years before that particular company gets its product approved and can generate cash flow. But for B2C companies, e-commerce companies, delivery companies, marketplace companies that are expected to be gaining great traction with customers and being profitable, I think those are the ones we'll see. We'll see a slower deal flow, and we'll see valuations declining now over the coming months.
The one I'm waiting for, I have to say, is when the Chinese ride into FoodTech. So very interesting. I've been having conversations with shipping companies at the moment. Very bizarre left field thing to say in the middle of a conversation about FoodTech. But if you talk to the shipping companies, they say to you, actually, The Economist picked up on this as well recently, as has a couple of blogs. There have been enormous movements of food into China. China's been buying up huge amounts of food at the moment. This is, everything from basic grains through to soy, through to meat. And if you look at the bulk carrier flows, there's huge amounts of food going into China. And what strikes me is that the Chinese, I think, have had a long-term plan, which is they're worried about food security. They are seriously worried about food security, largely because they don't produce enough of it for their own market. And what they're worried about is if you ever have a geopolitical conflict, it would be not inconceivable that, for instance, the US Navy could choke off many of their import points. So the Chinese, I think, have long term been concerned about food security. And I think it's intensified in the last 6 to 12 months. I think they've seen what's gone on after the Ukraine in terms of the grain shipments. And I think they thought, right, okay, well, whatever happens, we want to make sure we don't get caught in that kind of trap. So let's make sure.
On that, David, what I find interesting is over the past several months, the share prices of companies focused on traditional fertilizer products, such as nitrogen and ammonia-based products, have gone up and have gone up fairly strongly. And I think that points to your point that just when we're here talking about food tech and products emerging that can replace the nitrogen-based products of the past, just like we're seeing with oil and gas, fossil fuels going up just at a time when the world was moving the other direction. And that's caused by external shocks. And we as investors, we just have to be a little careful with that, a little careful, because I think we all know that the ultimate direction of travel, gravity is pulling the world and demand towards renewables and towards agricultural products that are not using nitrogen in these things. But for the moment, that's a sign of how strong this particular shock is, for sure.
Yeah, absolutely. And I think the next leg is we're starting to see a trickle through of VC deals in the food tech space, particularly around alternative proteins, particularly around biological alternatives to fertilizers, exactly what you talked about. And I think this is the start of a much bigger shift, because I think that the Chinese government probably realizes that if the Chinese eat more meat, pork's obviously a big major component of meat-based diets in China. That is a very variable, volatile industry. Not lots of problems with the pork industry the last year or two in China. They're very vulnerable in that space, and therefore I think we've already seen a declaration by President Xi that that they are very interested in not only food security but in food tech and alternative proteins. And I think one of the most interesting scrambles in the next 2-3 years is a lot of the plant-based alternatives and a lot of the cultured or cultivated meat still rely upon ingredients, nutrients. They still rely upon things that you put into a process. If it's plant-based stuff, you still need to basically feed in plant-based materials, things like soy and bee protein. If it's in the cultured space, you still need nutrients and media there. And I wouldn't be terribly surprised to see that the Chinese get very interested in that whole area. We're starting to see the stirrings of a quite substantial focus on alternative proteins within the Chinese market, both plant-based and non-plant-based. And the
Can I just comment on that, David?
Yeah.
That is where we are very optimistic and hopeful, and we're seeing constant innovation. And this innovation, science and technology, it doesn't stop. It doesn't stop because of wars or interest rates going up or inflation or anything like that. It continues apace. You cannot stop the pace of technology and innovation. And just today, for example, when you mentioned ingredients, I read that there's a company called BioBetter that's using a new protein manufacturing platform for producing growth factors using tobacco plants. So this is Nicotiana tabacum as a natural, self-sustaining, animal-free bioreactor. It's field-grown tobacco. They're plants that are going to be used for ingredients for lab meat. And they're claiming that they can reduce the costs of lab meat by using these new growth factors by a factor of 10 to 100. And this is just one of many news announcements we see every day and every week. And so I just wanted to point that out, that just while we see the macro trends of the moment, the things you can see right in front of you, trending back towards fossil fuels and old fertilizer products, there's incredible innovation underway every day that will continue to transform the entire ecosystem.
So on that thing, I just want to pick up on carbon pricing. Now, the whole carbon markets are quite already, even in a quite early stage, quite complicated markets, because on one end of the spectrum, you've got the European ETS scheme, which is the European emissions scheme, which effectively puts a price on each ton of carbon. And there's various ructions going on there at the moment, because the Poles, who've got a lot of investment in coal-fired power stations, are kicking back and saying that they basically don't like this ETS scheme. It's making their coal-fired power stations uneconomic. To Paul's point, exactly about getting fossil fuels back into the system. And then the other end, you've got, in the middle, we've mentioned this before about the farmers in Holland protesting around increasingly tough regulations around fertilizer runoff and that kind of stuff. And then all the other end, you've got more and more putative markets like carbon offset markets, and more people talking about how putting carbon back in the ground for farmers might be an extremely lucrative future source of income. And there's a couple of interesting stories that emerged in a few weeks, which I think link all these together. And I think the linking thought for all of these is that we're in a very difficult process whereby we're trying to put a price on carbon. Because fundamentally, a lot of what's going on, particularly in carbon offset markets, is about obviously reducing carbon dioxide carbon dioxide emissions, and they're putting a price on them. And when you put a price on them, it costs certain old industries an awful lot of revenue, which is what's happening with the Polish coal-fired power stations. And potentially could happen with farmers, because farmers are actually producing an awful lot of carbon emissions. So the vegan brigade is always busily attacking the meat brigade for the carbon emissions coming out of meat. And the linking thought there is that putting a price on carbon is extremely important, because if you put a price on carbon, you could then use the money that you raise in putting a price on carbon. You could actually use it to help fund farmers, for instance, to use new agricultural technologies to put carbon back in the ground. But the interesting thing is that if the government doesn't do that, it's not going to work. So there was a survey done only a couple of weeks ago where they asked farmers would they be interested in various technologies and processes and systems, everything from regenerative farming through to new tillage systems through to more complicated technological-led solutions. How interested they'd be to basically use carbon as a way of generating revenue. And what was interesting is that the vast majority of farmers basically said they would only do it if the government funded it. And I don't blame them, because let's be brutally honest, European farmers have been very reliant upon a subsidy regime, which is effectively the government giving them a check. So I don't entirely blame them for taking that action. But the government's only going to be able to fund this if it gets the revenue from somewhere else. And the revenue from somewhere else is carbon pricing. So there is this linkage going on, because one thing we're not going to do, let's be brutally honest, we already spend enough on agriculture subsidies as it is. So there's going to be massive kickback in the coming 5-10 years. If suddenly a new subsidy was landed on farmers, said, oh yeah, we'll give you existing subsidies. And by the way, we'll give you extra subsidies for putting carbon back in the ground. But that's not going to happen if everybody else is cutting back their spending on everything else. So the money's going to have to come from somewhere, and the money's going to have to come from carbon pricing. The problem here is that carbon pricing can work where you're easy to measure stuff. Yeah. So if you've got a coal-fired power station, there aren't lots of them. You can measure the emissions. They can be fairly accurate. Yeah. The problem with lots of other things is that the emissions from them are much more difficult to measure. And equally, the flip side of it is, if you're doing carbon offsets, you've got to measure the offsets. Yeah. Or you're putting carbon back in the ground, you've got to measure what you're putting back in the ground. So paradoxically, I think that two of the most interesting markets in the carbon markets at the moment are one around measurement, measuring both carbon emissions and carbon offsets back into the ground. I think it's a fascinating area. We're seeing lots of interesting technology emerge in that area, everything from satellites looking down from space, looking at farming land and seeing what their carbon emissions are. Drones, we've got more practical kind of hands-on technology emerging. So that's a hugely interesting area. So how do you measure the carbon impact, both positive and negative, is a fascinating area. And then once you've measured it, how do you put a price on it in a marketplace? Now, the European ETS scheme is a government-sanctioned scheme, where the price gets set, but there already are lots of private offset markets where we're putting a price on carbon. But what's interesting here, and I'll finish off my point, what the point about that survey of farmers is, farmers are really only going to respond if they make money from something. And that money will probably come via some form of subsidy, but it might also come from informal marketplaces that work alongside the government schemes, which allow them to basically make money. And these marketplaces are one of the most fastest growing areas within the whole carbon space, and certainly within the FoodTech space, because effectively what we're trying to work out, and this is the crux of the matter, is how do we get enough money to the existing stock of farmers out there to switch their practices. So how do we get money to them? And that money is only going to come from a combination of government subsidy and private markets where we have measurement going on. So the big game here is, how do you get money to those farmers to make a transition, because they ain't going to do it unless they get money in their back pocket to make the transition. Paul, any thoughts?
No, I agree with you, and I think it's you've articulated a very clear case for what I believe is inevitable. So, if you look at the U.S., we have seen a very clear, direct link path to subsidization. There wouldn't be any farmer industry in the U.S. without government subsidies. So it's inevitable, and we know based on inevitability that within some period of time, 20 years, maybe 10, 20 years, at least 30, that there won't really be a need for much of the farming industry as we know it today. It's going to happen. And the question is how it happens. And you've just articulated the case, and I think this is the way it will happen. And it's going to have to be subsidies and then measuring carbon properly so it can be priced properly. And marketplaces forming is a very healthy sign. And I think, for investors, this is attractive. But whenever you see something, as this has been my experience, that is probably inevitable, then the next question is, well, what's the imminency of this inevitability? Yeah. Is it next week or 10, 20 years from now? So I would just say, David, as a comment, more of a question, tick, totally agree. Next question is when, over what period of time will these marketplaces and measuring methodologies and companies who do the measuring.
Well, I'll come back to you directly on that. So I think, as is always the way with these things, I'll conclude our thoughts on this, is I think the private sector is way ahead of the game. So there are lots of interesting companies developing technologies around measuring those carbon emissions. And secondly, there are lots of companies developing marketplaces, a lot of them coming off the carbon offset markets, particularly through forestry, which has been around for a while now. The problem has been government, because government is stuck within a silo mentality where you have ministries of agriculture who have traditional subsidy schemes and try to fit this in to a traditional way of thinking about government largesse, but that is what it is, and government schemes. That's the difficult bit, because the governments have got to fundamentally get their heads around. And the UK government is edging and inching towards the right solutions. So they are looking at a whole series of kind of biodiversity and bioenvironment measures, but they're all a bit unformed. And if you're a farmer, you don't really care about high-blown words about transition, all that kind of stuff. What you care about is what I get paid next week on my government subsidy scheme, or next month, and that the devil is in the detail. And the great thing is, as I said, the private sector's already, I think, virtually there. You've got to have the government wake up and realize what they've got to do. Anyway, I think we talked too long. So we'll be back in a couple of weeks' time. And in the meantime, do go to our website, futurefoodfinance.com. We've got some great articles. We've got a big old survey coming fairly soon, next couple of weeks, on vertical farming, which we're very excited by. There's great interviews also about companies in the space. So definitely go and check out what we've got there. And in the meantime, eat well.
And sleep well.